Welcome back. We are diving right into the deep end with consolidated financial statements, looking specifically at how Pogo and Stick become one big corporate family. I've got your materials here showing Pogo acquiring Stick. Before we start crunching the numbers, how comfortable are you with the general idea of
Why
why
we
we combine these two companies? Boom. Let's go. I love the energy. We are about to crush this consolidation problem. First thing we always do is establish the squad. Pogo bought the entire share capital of Stick. That means Pogo owns 100% of Stick. Since Pogo owns everything, there's no outside interest to worry about yet. Does that 100% ownership part make sense to you? All right, let's get into the math. Goodwill is basically the extra money Pogo paid to buy Stick. Here is the core equation. We take what we paid, the consideration, and subtract the actual value of the company, which is the net assets. Check this out. In your notes, the consideration is $8,000. That's the investment in Stick amount from Pogo's balance sheet. Then we subtract Stick's equity at the date of purchase. That's the $3,000 in share capital and $2,000 in retained earnings. 8,000 minus 5,000 gives us 3,000 in goodwill. Does it make sense why we subtract the 3,000 and 2,000 specifically from Stick's column? Aha! Great question. You're exactly right that investment isn't on Stick's books. It's only on Pogo's because Pogo is the one who spent the cash. We add Stick's share capital and retained earnings because in accounting, those two together represent the total value or net assets of the company. Think of it like this. Net assets is what's left for the owners after all debts are paid. From your notes, Stick has assets of 6,500 and liabilities of 1,500. That 5,000 matches exactly with Stick's equity. 3,000 share capital plus 2,000 retained earnings. We use these to figure out if Pogo overpaid. Pogo paid 8,000 for something worth 5,000. So that extra 3,000 is the goodwill. Does that link between equity and net assets click for you? I totally see why you'd think that. In some parts of consolidation, we do just add them together, but equity, the ownership, is special. When we make the big final sheet, we add the other assets and liabilities from both companies. But for ownership, we don't add them. If we added Stick shares to Pogo's, we'd be double counting. Pogo's investment of 8,000 already represents Stick's value. If we added Stick's 3,000 share capital on top of Pogo's 9,000, we'd be pretending there are more shares in the group than there actually are. Does that help explain why we only use Pogo's share capital in the final result? You nailed it. These steps we are doing right now are the behind the scenes workings that happen before we can even touch that final consolidated statement. We just finished working 2 for goodwill. Now, we got to do working 3 for retained earnings. This is where we figure out what profits the group actually gets to keep. In your notes, Pogo has 6,000. For Stick, we take their 2,000, but subtract the same 2,000 because it was earned before Pogo bought them. That's what we call pre-acquisition earnings. Since Stick hasn't made any new profit since the purchase date of February 1st, the group share of Stick's post-acquisition profit is 0. So we are left with just Pogo's 6,000. Ready to see how all these numbers finally jump onto the consolidated statement of financial position?
From where did you get pre-acquisition and post-acquisition?
Great catch. We get those numbers by looking at the date of the merger. Everything Stick earned before that date belongs to the old owners, not the group. In your specific problem, the question says Pogo acquired Stick on February 1st, and the balance sheets are also as of February 1st. Since the dates are the same, Stick hasn't had any time to make a single penny of profit while being owned by Pogo. That's why the post-acquisition earnings are 0. If Stick had earned 3,000 by the end of the year, we'd subtract the initial 2,000 and the post amount would be 1,000. Does that help you see where the cutoff line is? Exactly. Right now, at this very moment of acquisition, there's been 0 time for Stick to earn anything for Pogo. So let's pull it all together into the final masterpiece. Notice how the goodwill we calculated, that 3,000, now shows up as an asset. It's like a new item on the shelf. For the other assets and liabilities, we just smash them together. 9,500 plus 6,500 for the assets, and 2,500 plus 1,500 for the debts. And look at that, 19,000 on both sides. It balances. Does it make sense why the investment in Stick of 8,000 disappeared from this final list? Boom. Exactly. You got it. It's an internal transaction. From the outside world's perspective, Pogo can't invest in itself. And that's what the group is now. One entity. You've basically mastered the core logic of Activity 1. The internal investment cancels out against the subsidiary's equity, leaving behind goodwill if there was an overpayment. I've put those flashcards on the board for you. Take a quick look. How are you feeling about these 5 key concepts? Sharp observation. You're totally right. Goodwill isn't listed in the original numbers, and neither is a retained earnings total for the group. Think of it like this. Pogo paid $8 million. But what did they actually get? They got Stick's physical assets and their business value. We have to do the goodwill working because goodwill is the invisible asset that explains why Pogo paid $8 million for a company that only had $5 million in equity. And for retained earnings, we can't just add Pogo's 6,000 and Stick's 2,000. If we did, we'd be claiming the group earned 8,000. but Stick earned that 2000 before the group even existed. The rules say the group can only claim profits made after the purchase. Since they just bought it today, the group has earned 0 from Stick so far. Does that make sense why we have to filter those numbers through a working first? $1 million question. It all comes down to one word: control. In your previous questions, you might have just been adding 2 departments or looking at a single company. But the moment you see one company buying another, the investment line on the parent's balance sheet is your signal. If you see investment in subsidiary on the parent's books, that's your cue to trigger the goodwill and retained earnings workings. You do them because the investment asset has to be replaced by the actual stuff Pogo bought. In the exam, they might just say, prepare the consolidated statement. They won't always tell you to calculate goodwill first. They expect you to know that goodwill is a mandatory part of that statement. Think of it like baking a cake. If the recipe says make a cake, it won't always say crack the eggs, but you know you have to crack them to get the result. Does that clear up when to pull out these specific tools? Boom! Love it. You're catching on fast. Since you've got the logic down for when to use these tools, you're officially ready to tackle any consolidation problem they throw at you. Since we've crushed activity 1 and you've got those revision flashcards on the board, would you like to try another practice scenario to see if you can spot the investment signal yourself? Or should we wrap here? Let's break it down. I'm going to give you a quick test scenario to see if you can spot the key numbers. First step of the breakdown. What are the total net assets of Company B that Company A is buying?